Well, what do you know? The S&P 500 managed to close above that significant critical level yesterday that we talked about in my last video, which is the 50% retracement level. So if you watched my last video, I said that whenever the market is in a bear market, it's dropped 20% in the bear market, and it's able to rally 50%, or rather it's able to make back 50% of its losses, then likelihood the bottom has been set in. So that's the top of this current bear market, that's the bottom, and we call that the A to B decline. And this level over here would be the 50% retracement level. And yesterday we closed very strongly above this level. And in my previous video, I showed you that if you look at the history of the S&P 500 in the last 65 years, every time you have a bear market rarely closing above that 50% level, that was it. The market did not make another new bottom. So in other words, based on this development yesterday, highly likely that June the 16th was the bottom of this bear market. Very unlikely that we're going to go lower than that. So does it mean that this is a confirmed bull market? Not just yet. Again, we are not in a bull market yet until we cross above this level, which is the 4364 level, which measures 20% above that low. But it does say that yes, we're still a bear market, but we are not going to go lower than that low. So where do we go from here? Now, before, some people watch this video and get really excited and say, okay, the bottom is in, I'm going to buy it right now, go all in. Wait a minute, right? Again, remember, the problem with a lot of retail investors is that they buy and sell based on emotions. And a lot of retail investors, they tend to sell at the worst possible time, right? I know a lot of chicken littles out there that listen to the prophets of doom out there, and when the market drops, oh my God, I'm gonna die, and they sell right at the bottom. That's what, unfortunately, most ignorant people do, and they get purged from the market, like I said in my previous event. Or they sold over there, right? Because they sell out of fear, out of panic. And now that the market is ripping higher, and a lot of people are now saying, okay, the bear market's done. What do these people do? They do the opposite. They start to buy in. They start to panic buy and okay, let's jump in, let's buy right now. Okay, so would I buy right now? No, I wouldn't. Okay, by the way, I've already bought. Those of you who are following me on my private community called UIP, you know that I've been buying shares very regularly in the last couple of weeks, right? So I've bought most of what I want to buy, but I may still buy a bit more. But I'm not going to buy right now, right here. Why? Because although, like I said, the bear market bottom is probably in, short term, the market is overextended. It is overbought. What does that mean? So again, remember that prices don't go up in a straight line. Yes, I do expect the market to make new highs by the end of the year or by next year. I don't know, right? It will make new highs, okay? But again, it will not go up in a straight line. Remember, the market always moves in wave patterns. Wave as it goes down and waves when it goes up, right? So for example, wave down, wave up, wave down, wave up. So it moves in these wave patterns. Similarly, on the way up, it's not going to go up like that, okay? So what happens after we got a wave up, wave down, and wave up? What tends to happen? That's right, you're going to have a wave down. You gotta have a wave down, okay? But may not be exactly here, right? I mean, it could go out a bit more and then wave down later on. So the point is never jump in on a wave up when it's overextended. How do you know it's overextended? Well, when the prices tend to move in a 90-degree fashion and they kind of stretch above the moving averages, that's a clue because it tends to snap back to the moving averages. Some people, they like to use indicators like stochastics and RSI, Williams percentage R. Yes, you can do that as well, but once you get very experienced in the markets, you find you don't really need these indicators because you can just tell by looking at the price action, right? But if you want, you can look at the stochastics, for example. For those of you who are, again, new to trading or investing, and you want to look at an indicator, yep, you can look at something like this. And you can see that we are in this overbought level, right? So whenever the market's overbought, it means it's stretched up. It tends to come back down, okay? But it can stay overbought for quite a while when momentum is very strong. Bear that in mind, okay? Now, so where's the next level of resistance? Let me remove this first, and I'm going to show you. So if I draw a trend line from here all the way down to here, you can see that this will be the next level of resistance. And this trendline resistance coincides with the 200 moving average over there, which is going to act as strong resistance. So yes, we are going to make new highs and higher highs by the end of this year or next year, but it will not go up in a straight line. Do expect a pullback, a retracement, which is very, very healthy. We need a pullback. So my guess, and again, it's just a guess, I could be wrong, right? My guess is we may go up to this level over here. We may go up here to this 200 moving average or this trend line, or maybe even exceed it a bit, and then we're probably going to pull back down. So we expect a pullback down. Again, how low, I don't know, right? No one can predict, but when it pulls back down, that would be a perfect time for me to add more shares. Okay, and I will add in things like credit spreads and all those things in order to ride the next wave up, right? And then slowly it's gonna chart to new highs. Okay, so there are a few reasons why I expect a pullback. The first reason, again, is because technically the market is short-term overbought. Number two, we are gonna face some strong resistance at the 200 moving average and the trendline resistance, and also because of seasonal reasons. All right, what do I mean by that? There are a couple of seasonal patterns that you need to pay attention to. On most usual years, you can see that the market tends to pull back in mid-September to late October, as you can see. So this gray line you see would be most years. And you can see usually what happens is the market tends to rally strongly in the August month and the early September month, right at the beginning of September, right? But by mid-September, the market tends to retrace all the way to the end of October. So these two tend to be bearish months. Again, does it happen all the time? Is it 100%? No, it's just a probability, all right? And then usually what happens is by the end of October, early November, hallelujah, we have that strong run all the way to the end of the year. So that is what usually happens most years. But this year is a bit special because this year happens to be the US midterm election year. And for midterm election years, it tends to be even more bearish in September and October just before the elections. And just before the elections, boom, the market takes off. So this line in blue refers to midterm election years, which is this year, 2022. And you can see that, again, the pattern, you will see the market tends to rally all the way to the third week of August, which we're going to approach next week. So we could still rally a bit more, and then we see a bit of a sell-off, all right, in September. And by mid-September, before October, in fact, we consolidate to October, and then early October, we have got that strong run. All right, so again, this is not, a kind of a prophecy or a prediction or sure thing. It's just a seasonal pattern, which is interesting to look at. Again, so if I'm investing, I don't want to jump in when the market's overbought. I want to wait for it to retrace nearer moving averages. And bearing in mind, again, resistance is nearby. We've got these seasonal patterns, so I would be more patient to add in more shares. But if you have been following me, you should have bought most of your shares in the last 2 or 3 months during that panic selling. Remember, panic selling, when everyone is being purged, people are selling, that's when you're buying. When everyone is buying and going crazy, FOMOing, that's when you're staying out of the market. Wait for panic and fear again to buy. Remember, you always want to buy when there's fear and panic. And when everyone is excited and they're chasing the market, you want to stay away from that. You got to go opposite of everyone else in order to make money. So this is based on what we call these monthly seasonal patterns. And of course, you've got this big pattern, which I talked about a lot. And this comes from Larry Williams, which is the Decennial Pattern. And the decennial pattern basically is a pattern of all years ending with a certain number. And if you look at all the years ending with 2, which I've mentioned many times before, they tend to follow this pattern. And so far this year has been pretty spot on. You have to agree with that, right? Where years ending with 2, again, they tend to be very bearish all the way to the end of July, right? Which played out very well this year, okay? And then you can see the market rallies very strongly. And whether you're looking at this pattern, the decennial pattern, or the election pattern, or the usual monthly pattern, what do they all have in common? What they all have in common is you have a pullback, right? You always have a pullback in, again, September, October. We don't know exactly when, but there's going to be a pullback, and that is the opportunity to really pile in to get on this bus. Last chance to get back on the bus before, hallelujah, we make new highs in the market. Now, as I show you all these chart patterns and seasonal patterns, and I talk about, probability that the market will likely go up or go down based on the trend, always remember that, again, in the short term, no one can predict for certain where the market is going to go. No one can do that, right? Anything can happen in the markets. But always remember that in the long run, good companies will always go up in value, always. And the index will always go up in the long run. And the good news is, again, you do not have to predict the market in order to make money from the markets. Many times when I do all this analysis, I tell my students that they're purely for entertainment purposes, that even if I'm dead wrong, it doesn't matter. We're still going to make money anyway. Why? Because we are buying into the best businesses in the markets. We are buying into the index. And you will always make money as long as you have the discipline to dollar cost average and to hold for the long run. And if you're trading, you got to put a stop loss. You got to get out when your stop loss is hit. You have to ensure you take profits which are more than your initial risk. So whether you're trading or investing, you should make money consistently, even if you can't predict the market to save your life. So predicting the market has nothing to do with making money. Always remember that. The reason why a lot of people lose money or they never get a chance to make any money in the markets is because they're impatient, because they're very short-term focused. You only focus on the short term, and if you focus on the short term, you can never ever build your wealth. Like a lot of people say, Adam, how can you talk about the stock market? The stock market is so risky. You say that I need to invest in order to beat inflation, but by investing, I lose more money than holding cash. That is true in the short term. For example, if you can see year to date for the first 6.5 months, if you held on to cash and just bought short-term bonds, you can see that, yes, you would still have lost a bit of money because of inflation, right? But if you hold on to stocks, you would say that, hey, I lose even more because the stock market dropped 24% for the first half of the year. And people look at this and they think that, hey, holding cash looks safer, which is true in the short term. But in the long run, in 5, 10, 15 years, look at this chart. You can see that over the long run, holding cash into money market funds or bonds or fixed deposits, in the long run, you do not build your wealth. But when you hold on to good companies or the index, yes, in the short term, you go through these big ups and downs, but at the end of the day, you always end up much better in terms of your wealth. So remember that in the long run, the longer you hold cash, the more risky it becomes for you. But the longer you hold stocks, the safer it becomes. Here's another chart. And again, the trouble is a lot of people, they are always afraid of getting into the markets. That, what if I get in and the market crashes? What if I buy at the top? Who cares? Even if you bought at the top, look at this, right? In the last 10 years, even if you bought at the top of every stock market cycle, you were so unlucky, you bought at the absolute top. And every time you bought at the top, it crashed. You bought at the top, it crashed. Even if you did that, you would still be better off than people who didn't dare to get in at all. Let's look at some specific numbers. How many of you know people who never ever invest because they always believe the crash is coming and they always believe that lower prices are coming? So because of that, they procrastinate, and they never ever get started, right? And Here's an interesting table. If you take a look at, for example, again, the last 20 years, from 2001 to 2020, okay, and you decided to invest $2,000 a year into the S&P 500 ETF, the SPY, how much would you end up with? Well, it depends, right? So if you manage to buy at the bottom of the market every year, you had perfect timing, which is of course impossible. But if you could buy or you could invest $2,000 at the market bottom every year, by the end of that period, you would end up with $151,000. Not bad, right? Now, what if you just invested immediately at the start of every year? So the first day of the trading year, you just invest $2,000. That's it. Goes higher, goes lower, I don't care. You would end up with $135,000, right? Now, what if you did dollar cost averaging, which means that you took your $2,000, you divided it by 12, and that gives you $167, and you put in $167 every month. If you did that, then at the end of the period, you would have $134,000, okay? Now, what if you were Mr. Unlucky? You had the worst possible timing, that every year, when you invested $2,000, you bought at the absolute top of the market every single year. Guess what? You would still end up with $121,000. I mean, not as great as Mr. Perfect Timing, right? Not as great as Mr. Buy at the beginning, but you still end up making money. Now, the worst person would be the person who stayed in cash, who again read all this doom and gloom news every single day. From people saying that the market's gonna crash, we're gonna have a Great Depression, we're gonna die, and they read all this crap every single day that they never get started because the crash is coming soon, the crash is coming soon, the crash is coming soon, and by the end of the day, they will never ever be financially free. They'll never be financially secure. They'll always be trapped in the rat race of mediocrity. Don't end up like Chicken Little and SpongeBob SquarePants. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.